So good afternoon, and thank you very much for joining us this afternoon. Um, so we're going to take you through test one, preparation for takes 3761, right? So the subject matter of taxation is a very easy, at the same time, very difficult module. So why would I say taxation is easy and at the same time taxation is difficult? Well, because when you talk of taxation as a module, so I would like to compare that with another module at third level. So I would take, for example, MAC 3761. Do you know, for me, I'm a tutor. I teach both taxation, I teach MAC, I teach FAC, right? But the easiest module in my life, if which I if I had an option, I would just choose MSc. Right? I would just choose to teach MSc. And the reason why I would do that is because with MSc, I don't need to practice in advance. I don't need to read. It's so easy. It's so simple because it's all based on logic, principle. But when it comes to taxation, it's based on rules, right? So you don't have to reason taxation. You need to know the rules. And then the rules aren't just standalone rules, silos. They have a lot of clauses. They have a lot of overriding principles. They have a lot of provisions. So you might say, for example, you might know that for VAT purposes, if we export to foreign country, right? Then exports are zero rated. That would be better if that was just there and we stop there. But then there's a lot of, however, if this happens, then that, if this doesn't happen, then it can't be. So there's a whole lot of those things. And so what I'm saying is you can't really reason those things out. You have to know. And for me, that's a punishment. Okay. So I'm a tutor for this, and it's very easy. Once you read it, then it's very soft. But if you do not know the rules, it's going to be very difficult. So the best way that I have recommended over and over for studying taxation, which students also acknowledge as the best, which is also effective in the sense of saving time. So the best way to do this is to start with questions. So I believe that you have learning units or study guides which have end of chapter, end of learning unit questions or self-assessment questions. So if you start with those questions and the answers, you look at the question, look at the answer. You don't even have to study, and then you try to reason, to think rather, why are we making this adjustment, right? And then after that, then you can go read the material, and everything that you were seeing would start making sense. So it saves a lot of time. So it's a more effective way of studying if you start by going through the questions, asking yourself, why are we doing this adjustment? Why is this the case? Why is that this amount being treated like this? And so forth and so forth. And then from the question and the answers, then you can go and read from the textbook, and then everything should make sense. So, welcome to the world of taxation, actually. So, I would like to start by introducing you to how do you answer taxation questions. But I'm going to confine my discussion to VAT questions. So we basically I wanted to talk about the discussion question. Okay. So how do you answer a discussion question? So these are the key points that you need to pay attention to, right? So a question is going to ask you to discuss, right? Let's say it says, discuss the VAT implications. Now, in taxation, we have to be very, 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 very careful because a question could say, discuss the income tax implications. Okay. Right. So if a question would say, discuss the income tax implications of a transaction. So that would mean we want to look at income tax in particular, right? Normal tax payable. So that would include things like our normal tax and capital gains tax, right? Capital gains tax, right? So we won't just discuss any other tax implications. If a question says discuss the VAT implications, then we want to think in terms of input VAT or output VAT because the question says discuss the VAT implications. Sometimes a question could say discuss the tax implications, right? Discuss the tax implications. All right. So do you see here that doesn't specify which tax? Is it donations tax? Is it dividends tax? Um, is it VAT? Is it income tax? So they just say discuss the tax implications. So what you do in such a case is that you're going to answer the question based on, because the question says discuss the tax implications. So you're going to answer that question, right, based on all the taxation, the taxes you have studied in your module to date, right? So we're going to focus on our module at that point in time. So if it is at the beginning of the um, um, let's say it's test one, and we're going to do VAT and income, gross income and stuff, right? And then the question says discuss the tax implications, right? Then we're going to focus on the VAT and the income tax, which we have covered so far. But we won't be talking about capital gains, right? Because we haven't covered that yet. We won't be talking about donations tax because we haven't covered that yet. Okay, so it's something that is very important for you to pay attention to what text is actually required. Right. So I showed you that you could be required to discuss the tax implications, or more specifically, income tax implications, or donations tax implications, or VAT implications. Now we're going to focus on VAT. So we're going to focus on VAT. So you first of all need to to identify the status of the parties involved. So X is going to buy um, from Y. So is X a registered VAT vendor? Is Y a registered VAT vendor as well? Okay. So you need to know that. Then, when the question says discuss the VAT implications, we need to know from whose perspective. Is it from the perspective of X? Is it from the perspective of Y? From whose perspective are we going to do that discussion? Because the question will say discuss the VAT implications in the as they pertain to Y limited. And if we don't pay attention, we might discuss the VAT implications on X instead of Y. Right. So we're going to look at which tax are we referring to. So if it is VAT, we know that it's not income tax. We know that it's not donations tax. It's not capital gains tax. It's value added tax, right? And we now also know from whose perspective? From the perspective of the buyer or from the perspective of the seller, or both? So if the question says, do you discuss the VAT implications of the above transaction, and doesn't tell you from whose perspective you should discuss that, then it has to be from both sides. Okay? Unless the question makes it clear from whose perspective it is, we're going to discuss both perspectives. And as we discuss VAT, we need to distinguish between input VAT and output VAT. Okay, so that is very important. We need to make a distinction between input VAT and output VAT. We don't just say VAT there. Okay. And the other thing that you as a student need to know is the correct terminology used. You know, if you go to even at honors level, that is the CTA, or even if you go to board exams, if if you want to be a chartered accountant, you're going to board exams. You'll see students confusing these, and it's just not unbelievable. How do you get to board exams and you confuse output VAT and input VAT? And then the other thing is you need to know the correct wording to use. You claim, right? Remember, you claim input tax credits. You claim input VAT. You claim, right? You don't claim output tax. You don't write like that. You claim input tax credits. You levy output VAT. Okay. You don't charge input tax. You claim input tax. You don't claim output tax. You levy output tax, or you charge. Right. Remember that. So those little things count a lot in the profile you build when somebody's going through your work. So you need to know whether the VAT we're talking about is input or output. Because when a question says discuss the VAT implications, then that's broad. They didn't say discuss the input VAT or output VAT. The question says discuss the VAT implications of the transaction. So we have to focus on both implications: input VAT implications, output VAT implications. So imagine a question that says, discuss the VAT implications of the above transaction. So we're going to discuss input and output, as well as both X and Y, supplier and buyer. Because the question says, discuss the VAT implications of the transaction. It doesn't tell us for X or for Y. All right. So if it doesn't tell us, we discuss for both and have input and output VAT. So those are things that are very, very important that you must pay attention to. Okay. Because you will lose a lot of marks that you are not supposed to lose. Then the apportionment of the VAT. You guys know that VAT, input VAT, to be precise, is going to be apportioned based on any ratio provided in the question, or if the ratio is not provided, then we're going to use the ratio of taxable supplies, right? Taxable supplies against non-taxable supplies, right? And remember that taxable supplies could be taxed at 0%, which makes them zero rated. Not so. And they could be taxed at the standard rate, right, at 15%, which makes them standard rated. So you need to remember that taxable supplies refers to two categories, both zero rated and standard rated. So if something is zero rated, then it's a taxable supply, right? Don't forget that. So taxable supply doesn't mean standard rated. It means taxable, including zero rated supplies. So that's important for you to know, because if we're going to make an apportionment, right, it's based on the taxable versus non-taxable. So if our supplies are zero rated, is 20%, Standard rated is 40%. Then the exempt or non-taxable is 40%. Then the ratio is going to be 60 as to 40 because taxable includes the zero rated plus the standard rated. Then our apportionment would be claiming input tax, and we apply the input tax ratio of 60%. Okay, because that's the taxable. Remember, we can only claim input tax to the extent that we're making taxable supplies. Right. So if we are not given any percentage, we're going to use the percentages of these taxable versus non-taxable supplies. So for input VAT, please pay attention and do not forget that. All right. So remember that. And then another input before we start to go to the questions. Another input there on apportionment is that you only apportion input tax, right? You never apportion output tax. And there are two exceptions because we say you only apportion input tax and not output tax. So then there are two exceptions to that. Okay. So what are those? So those, when we apportion output tax, for the purposes of our level, all right, TAX3761 third level, we have two options, two options. How is it options? Two instances where we have to apportion output tax, but we never apportion output tax except in those two circumstances. So is it I think this is the right of use of motor vehicle. Correct. We're going to apportion the output tax um, and what else is it? Is it an insurance indemnity? So if we get a payment from insurance, we can also apportion the output tax. So this is the only output tax that we apportion at our level. Then we also come to the de minimis rule. The de minimis rule. So the de minimis rule says that if we make taxable supplies that are 95% or above, then we don't apportion. Let's say taxable supplies is 96%, then exempt is 4%. Then we're not going to multiply our input tax by 96% because it's 95 or above. Right. So the de minimis rule says you do not apportion. So whenever rather, let me repeat that clearly. The de minimis rule says you do not apportion if the taxable supplies are 95% or more. So when you read your question, please pay attention to this. If they tell you that they make 95% taxable supply, then you must know that there is no apportionment of input VAT. Okay, right. So that is nice. I hope you appreciate that. And at this stage, you have done a lot of reading, right? So you have attended this session just to make sure that what you know is probably what you're going to be taught, right? Just to get a gauge on your knowledge to assess your readiness for the examination. And I wouldn't be impressed if you go through this and you learn a lot of things, maybe one or two, just to reassure you is the purpose of this session. So I would expect that you know most of these things we're talking about, and I'm happy if that is the case. Brilliant. Then we come to the time of supply. So what we refer to as the time of supply is the time that we're going to record the input VAT. No, why do I say input VAT? We record the VAT, whether it's input or output. All right. We record it in our accounting records. Remember that um, VAT is periods. The periods we normally deal with is just A and B categories, rather A and B. So I want you to know what category A and B are, because they are for taxable supplies that do not exceed 30 million rand. All right, so that's very nice. And the difference here between A and B is that they end in different months. A starts from January. Um, does A end in end of January? Right. And March and so forth. And category B starts is January, February, um, and January, February, March, April. Right. So it ends in the even months. Then the category A is the odd one. It ends on the odd amount or odd months. But they're basically the same. You have to be below 30 million rand. So I want you to check again for categories C, D, and E, as well as VAT registration. Okay. VAT registrations. When is it compulsory to register for VAT? That is very important. So I'm talking here about the term of supply. Is the term of supply is the basically the tax period in which a VAT is going to be recorded. In which tax period should it be recorded? But sometimes we can recognize something, right? So that those are interesting things. But we may not be allowed to claim because of other reasons related to VAT rules, right? So we discussed that. So it's not always the case that the term of supply is the term of claiming. Sometimes they do not coincide. The term of supply is the tax period, but even though we might recognize it in that tax period, we're not allowed to claim that because there's some outstanding requirements for VAT. Then the value of supply. The value means the amount excluding VAT. So the value is the amount on which we apply the VAT. Right? The value means the amount excluding the VAT. Consideration is the amount including the VAT. So when we deal with consideration to get VAT, we use 15 over 115. Because consideration is the VAT inclusive amount. Value is the VAT exclusive amount. And to get VAT, we say 15%. So these things are the things you must discuss when answering VAT questions. Identify the VAT status of the individuals. Identify whether it's input VAT or output VAT. Is there any apportionment? What is the time of supply? And what is the value of the supply? That for you to do that, you'll be using the rules, of course. The rules, what the rule says this, the rule says this, the rules say, and so forth. So forth. Brilliant. So I'm going to take you through a discussion here. And this discussion is by no means exhaustive, and but it's just there to allow you to assess your understanding, your preparedness, and your understanding of the VAT. All right. So, like I said to you, if you can get one or two things, I'll be very happy. But if you can get, so I would say if you can get 10% additional knowledge, I'll be very happy. But if you get 50%, then I'll be happy again, but I'll be wondering, haven't you been studying? What happened to you? And as long as it adds value to you anyway. So let's talk now. The first choice I made is the motor vehicle fringe benefit. So it's an interesting concept because it affects VAT and it also affects the normal tax of individuals because the fringe benefit goes to an individual and the fringe benefit also affects the VAT of the entity. So if you want something that is plus or minus always going to come in the exam, right? This is the thing. Your motor vehicle fringe benefit, you should really know that. It's not difficult, but you need to really know that. Like I said to you, remember with taxation, you won't exhaust all the knowledge. It's just not possible. Even the custodians of the Income Tax Act, the SARS people, sometimes get it wrong with their interpretations and, well, wrong from the perspective of the law. Right? Okay. So I wouldn't expect you to know everything inside out, but I would expect you to have the knowledge enough to get a 70 and above, and 70% in a test, and 80% in a test, 70% in the exam. Yeah, that is quite acceptable. If you can get more, then that's great. But I say now, the motor vehicle fringe benefit, it's one thing you should definitely know when you get into examination. Right? You can't get into the exam and you do not know this in terms of VAT and normal tax. That's for exam purposes. But for test one, it's just for VAT purposes that you must know this. Right. So we required here to lead us into the discussion. The question says, discuss the VAT consequences of the transaction below. Now, I'm sorry. I just I wrote this question so it might guide us through the discussion. So it's not going to have the exactness in answer as you would be required. But what I mean is the question says discuss the VAT consequences. So when you discuss the VAT consequence, um, they didn't say it's input VAT. They didn't say it's output VAT. They just say VAT. So we're going to discuss both input VAT and output VAT. We are going to discuss both. Brilliant. And then just of the transaction below. And we are not told in from whose perspective this transaction is being discussed, right? But we're going to focus on the buyer because the information provided is about the buyer, right? When you deal with a question, there will be sufficient information to tell you what is supposed to be done. So this is a generalization that I did just to allow us a discussion. It's not exactly the type of questions you will get because we expect the questions to be more specific, to be more precise. Okay. So here's the query. The query says some guy purchased a double cab bucket, and you know it already, right? That this is a motor vehicle, a motor car, sorry. This is a motor car as defined, right? Because it's designed for carrying passengers, right? And not for business delivery, but for carrying passengers. Okay. And they bought it for 385,000. And you should know that the buying price, right? This is what I wanted to say. When you deal with VAT, right, all amounts are inclusive of VAT, unless they specifically say that this is not. So when you deal with VAT, you need to know whether the amounts are exclusive of VAT or inclusive. So when you read a question, right there at the top, they will plus or minus tell you the tax status of the individuals. They will tell you whether amounts include or are exclusive of VAT. And you just remember, is it from the 1st of April 2018? Our VAT rate changed from 14% to, is that correct? To 15%. To 50%. So our VAT, so if a transaction occurred before the 1st of April 2018, if a transaction occurred then we need to remember to use 14%. Say a motor vehicle was purchased in 2017. So remember that your VAT would use the 14%, right? So always check for the dates and check for whether the amount is inclusive or exclusive of VAT. So we have a double K bucket during January, that was purchased during January 2023 and granted the use thereof as a fringe benefit. I need to say as a fringe benefit to the marketing manager on the 1st of February 2023. Then the marketing manager is obliged to bear the full cost of maintaining the vehicle. Right? So you can, you can see the build-up of things already because you've been studying this. That's not the first time. So Prosper Limited requested you to briefly discuss and calculate the VAT implications of these transactions and to provide them with the corresponding journal entries relating to the VAT implications of the transaction. Right. So as you can see here, we discussing this from the perspective of Prosper, which is the entity we're dealing with. Now, if you look at this question precisely, it doesn't give you information as whether Prosper is registered for VAT or not, whether the buyer is registered for, whether the seller is registered for VAT or not, because it's part of a bigger question, and the bigger question would have told you right at the beginning that all entities are registered VAT vendors, all amounts are inclusive of VAT, right? So on the basis of that assumption, Prosper is registered. And the default assumption, though, is that all entities are registered for VAT. This is for taxation purpose. So when you're dealing with tax 3761, all players, all parties are registered VAT vendor, and all amounts are inclusive VAT, unless specifically told they are not inclusive, they are not registered. Right. So how do we start here? This question here, I want you to look at the question. Right? The question says, discuss the VAT implications. Do you see that they didn't mention input VAT, output VAT, just VAT? So in your approach, you need to make sure you have addressed input VAT, output VAT. Right. So your starting point, because this is a discussion, your starting point is to identify the tax status of these two guys, right? So I would say the seller is a registered VAT vendor, the buyer is a registered VAT vendor. So that would be where I start. So then the next thing is I would identify whether the transaction involves input VAT or output VAT. So we purchased this, right, for 385. Okay. So I would say Prosper paid VAT, paid for input VAT in the purchase price because the amount is inclusive of VAT. So the amount of VAT that they paid is 15 over 115 multiplied by 385,000. Okay, so then I'm going to write down the amount. And I write it down because I want to single out exactly how much was paid. How much is VAT? Because in this amount here, we're talking of VAT, right? Before we're talking about whether it's allowed or not, it's there, right? There is VAT in there. That is, you get a mark for that, depending on the marks being allocated. But generally, you would get a mark for mentioning that there is VAT there because the seller is a registered VAT vendor. The seller therefore added output VAT, and for us, when we paid, the purchase price included VAT, so we did pay input VAT, right? But in this case, this is a motor car as defined. A motor car as defined. So therefore, input tax is denied. But you see here that before input tax is denied, it has to be there So there is input tax in the first place. And that input tax is denied. Therefore, we cannot claim that input tax. So we're not going to recognize it. Okay. But before we deny it, it has to be input tax in the first place. So that's why we say there is input tax in the first place. Because there's no point about us, for us talking about something being denied when it was never included in the first place. Well, you cannot be denied something that was never included. So we need to identify that there is, in this amount, there is input tax, which was paid by Prosper for this amount, but the input tax is denied. Therefore, it's zero. Then we're done with that purchase transaction. Now we go to the use of the granting to the marketing manager, right? So the granting, you know that the first thing you need to determine your what we refer to as the determined value. And this is excluding VAT, right? That's the determined value. Because this is a fringe benefit and you need, all right, we're not going to talk much about fringe benefits, but I'll just say to calculate this fringe benefit, because there's a deemed supply, right? So let me rather take you step by step in how you actually answer the question. So now when you talk of this, of the vehicle supplied to this marketing manager, you say the supply of the vehicle to the marketing manager constitutes a fringe benefit, which gives rise to a deemed supply for VAT purposes. So first of all, we need to mention that it's a fringe benefit that that gives rise to a deemed supply, or that is deemed to be a supply for VAT purposes, right? And then the VAT purposes, we need for VAT, the determined value has to be calculated excluding VAT, right? So I will have 385,000. That's my calculation. Multiplied by 100 over 115. Then on that determined value, I will use 0.3% to determine the cash equivalent of the fringe benefit. 0.3% because input tax was previously denied, right? So I will use 0.3%. If input tax was not denied previously on this right of use of motor vehicle, then I would use 0.6% to calculate the cash equivalent of the fringe benefit. Then this input tax was not denied. Right. And then you must get an amount here. Then this amount that you get is called the cash equivalent of the fringe benefit. Okay, I hope I haven't reviewed my knowledge in a long time, but I trust myself. I wouldn't mislead you. So I think that is the correct word to say. It's the cash equivalent of the fringe benefit, right? If it's not, then it's not very far from the correct word, right? Now, from the cash equivalent of the fringe benefit, we now, once we have these, we're going to factor in whether, it's very interesting, whether is this guy bears the full cost of maintenance for the vehicle. So if this individual bears the full cost of the maintenance for the vehicle, then we're subtracting 85 rand. So that's the standard questions for us. We subtract 85 rand. If the individual bears the full cost of maintenance of the vehicle, right? If the individual does not, then we do not subtract this. Okay, and then from that amount, now we're going to calculate the VAT, right? And the VAT is assumed included, right? Where is it? Right, so there's going to be a deemed supply, and so we're here, right? We've done this. This is the cash equivalent, the fringe benefit. We subtract 85 rand because this guy is bearing the cost of the maintenance. Then we calculate the VAT monthly. Now, this is the VAT per month. We use the tax fraction 15 over 115 per month. So it's 119 per month. So if it was for 2 months, we multiply that by 2. Okay. All right. And so that is what we do. 0.3% is used as the input tax was denied. So we have determined this is the consideration. And the consideration is required in determining the VAT. And the consideration here is inclusive of VAT. Okay, so if one thing I need to mention is that in this case, there was no apportioning of VAT, input VAT, because we don't have that information. But let's say that this was 60% taxable supplies, 40% non-taxable supplies. Then our output VAT would also be multiplied by 60% the taxable supplies. And remember that the apportioning of output VAT apportionment applies only for fringe benefits, right of use of motor vehicle, or insurance indemnification, right? When we receive proceeds from insurance. Okay. Then, so when is the term of supply? The term of supply, obviously, we don't have a term of supply for input tax that was denied, right? So we won't talk about the term of supply for input tax. But now, for output tax, the term of supply, because the supply here is being made to the employee, right? So when the employee is considered to have consumed the benefit, is when the employee is paying tax for that benefit. So the term of supply is when the employee becomes subject to employee's tax. So whenever they pay tax on that benefit, then that's going to be the time of the supply. So it will be obviously in the same month that they received the benefit. Now let's talk a bit about, let me see. Right, so the journal here would be, we debit employee expense, or it could be debit in a salary, and then we credit output tax. Right. Let me see what I should emphasize here. Right. The emphasis from the comments is that we can only claim input tax on goods that are used to make taxable supplies, okay, or mixed supplies, and never exempt supplies. So that's the message. Then the other message we have is we need to know a motor car. For our purposes, anything designed for transporting passengers is a motor car. Right? Doesn't matter whether you rent it, whether we buy it, as long as what has been supplied is a motor car, input tax is going to be denied. Okay. And then the sequence is important. The sequence in which the amount of the deemed output tax on the fringe benefit is calculated is very important. The 85 rand must be deducted first before the tax fraction 15 over 115 is applied, right? So we're going to have the amount inclusive multiplied by 100 over 115 to remove the VAT. Then now we have the determined value multiplied by 0.3%. Remember, this is not 0.3, it's 0.3%. It's not multiplied by 0.3. Right? Please remember that. Because the students then make the mistake and multiply by 0.3. It's 0.3%. Okay, so don't forget that. Then from there, we can now, so I said this is the cash equivalent of the fringe benefit. And on that, we subtract 85. Then after, so the 85 rand must be subtracted first. Then after that, we apply the tax structure. And what you get here is going to be a monthly output tax. So you multiply that by the number of months. This is going to be the monthly output tax. Okay. Let me see if I have other notes. So I think this is the same notes that I've been talking about. And then one thing I need to emphasize before I leave is that a thing of diminishing value of a fringe of the determined value. Say for every 12 months that the current user who has been given the car didn't have that car for not a financial year, but for a full 12 months, right? Counting from the time that that guy received it. So if we have a full 12 months, then the determined value is going to be reduced by 15%. Right. So let's have a quick look here, um, just so we can assume this was the case. So let's assume this was bought in January. So this was bought in January 2023. So let's assume this was bought in August. This is 2023. So August 2020. August 2020. Okay. So as you can see, from we move, let's say it's 1 August 2020. So the first month, the first year would be 1 August. My apologies. So now is it 20? Yeah, 2020 is fine. So 1 August 2021. This is the first 12 months, right? So from the date it was bought, that's the first 12 months. So it's going to be reduced by 15%. That's the determined value. Then from 1 August 2021 to 1 August 2022, that's the second 12 months. We reduce again by 15%, diminishing balance. Right. Then from 1 August 2022 to 1 August 2023, he is already owning this. So it's not a full year, or it's not a full 12 months. So we would have to reduce this by 385,000. Okay, multiplied by, we reduced by the first, all right, so let's say 100 over 115. Then we reduce that by the first 12 months completed, so it will be 85%. And then the other 12 months completed, it will be 85% again. So this will be our determined value that has been reduced. And from this value, we're going to apply the 3% or the 6%. And from there, we can subtract the 85 rand if the guy was using that form, is responsible for bearing the cost of maintenance. Okay. Brilliant. So we've done motor vehicle because I thought that was particularly important. Then insurance indemnity payment. Remember that it has to be a contract of short-term insurance. Because if it is long-term insurance, it stands a very good chance of being what is this thing called? A financial service? A supply of financial service, which is going to be exempt. So it has to be in terms of the short-term insurance policy. Okay, so if they tell you that this is for a long-term insurance, then you must know long-term insurance, we generalize that as a financial service. And the supply of financial services is going to be exempt. Okay. So when we receive output tax, okay, when we receive output tax, when we pay output tax for an insurance indemnity, um, we consider that indemnity as a deemed supply, right? Um, but we only pay output tax if the asset initially the input tax was claimed. All right. So if the asset was, we claimed input tax and then it was insured, then when we do receive an insurance indemnity, but we won't account for output tax because the motor car was, the input tax was denied. So if the input tax was not denied, then we're gonna have a deemed supply for VAT purpose. So I will repeat that. When dealing with insurance indemnity, we first of all need to know whether input tax on that asset, whether input tax was claimed or it was denied. Okay. Um, so if no input tax was claimed on that asset, then when we receive an insurance payout for that asset, there is no deemed supply, right? But if input tax was claimed, then there's going to be a deemed output tax on that. Right? And remember that unless specifically told, the proceeds received is going to be inclusive of VAT, right? And the date of receipt is going to be our term of supply. And so do not forget to apportion as well. Firstly, when dealing with input tax, but also if it is an insurance indemnity, uh, when we receive it, we have to apportion that as well. The input tax is going to be apportioned. Um, okay, so we have spoken about this apportionment and the de minimis rule. Um, and this is also very important. So may I bring it to your attention that whether a motor car is purchased or rented on a day-to-day basis is irrelevant. The input tax will still be denied because it is the motor car which was supplied. So the concept here is it's not the manner of supply, but the asset supplied. So the asset supplied is the motor car. And as long as it is the motor car supplied, then the input tax is going to be denied. So you might see that you might have been supplied a motor car and you, through a rental, you get a car from a rental company and you use that for your journey or whatever you are doing, right? You cannot claim input tax on the rental of a motor car because it's not about whether you purchased that or not. The motor car was supplied, whether through rental agreement or through a purchase. Okay, so that's some things that you must just keep in mind. Then moving on quickly, let's talk of immovable property, because the immovable property is of great interest. Okay, so remember that whenever immovable property is involved, we have to pay tax to SARS. It could be VAT or it could be what's this other thing again? I forgot now. When we are not registered for VAT, what do we pay? Duty, transfer duty. Right. So it's either we're going to pay input tax or there's going to be transfer duty. And we are not talking here of SARS, right? We're not talking of SARS and the Income Tax Act and all the complications. We're talking for our module. Like when we get a supply of immovable property, we're going to consider transfer duty if VAT was not charged. So here's a query. There's an entity uh, which is registered for VAT. Okay. then is considering the acquisition of two buildings for investment purposes. The first building is owned by a non-vendor, and the purchase consideration is 2.5. So there's a non-vendor, right? And the consideration is 2.5. Remember, this is therefore inclusive. This building comprises shops and offices in the ground floor and residential flats on, so there is shops, offices, then residential flats. Then the ratio of use is 40% for commercial letting activities. So commercial letting is taxable supply. So 40% taxable supply. Then we would believe that the other 60% is a non-taxable supply. So I want you to look at the reasoning here that we're going to follow in discussing the VAT implications. Then we have the second building. Is owned by a registered VAT vendor, right? And the purchase price is given, it's inclusive. The building comprises mainly shops and offices, but 10% is let for residential purposes. So 90% here, 90 as to 10. If the company does the purchase this building, it will convert the residential section that is suitable for commercial letting activities immediately upon acquisition. So it's going to convert from residential to commercial. Both buildings are fully occupied. The parties to the transactions are not connected persons. Okay, so now we need to discuss the VAT implications of this, but on from the perspective of the buyer. Like I said to you, the starting point in a discussion is to identify, okay, is to identify the status, the VAT status of the people. So your starting point is this guy is a registered VAT vendor. The seller is a non-vendor. So there will be no VAT included in here, right? So that's exactly what you should say. Because the seller is a non-vendor, this amount is not inclusive of VAT. That's exactly, because the starting point is how much VAT is included in that amount. So there's no VAT included in there. The seller didn't charge output tax. They didn't levy output tax on that amount because they are not registered. So your starting point, identify the status of the taxpayer and how much, what that means for tax being, for input tax or output tax in the amount under consideration. Then we know that this will be a supply of second-hand goods. Supply of fixed property that was previously used is the supply of second-hand goods. Okay, and you know that rule. And with second-hand goods, it's going to be, so it's second-hand goods, it's going to be a notional input tax. You need to mention that is allowed. Okay, and all right, they want to use it for 40%. Okay, all right, that is fine. So there's a national input tax, and then the national input tax is based on the lower of the open market value or the cost, isn't it? How much does it cost? In this case, we don't have the open market value, we just have the actual cost. So it will be based on 15 over 115, the tax fraction, multiplied by the, that's the consideration, 2,500. So, but we need to mention here that the seller never charged us VAT, but we are allowed by SARS to calculate deemed VAT, deemed input. And remember, we always identify that as input, because that's one of the things I said. You need to distinguish between output or input. So this will be input VAT. So that's very nice. And remember, the apportionment also is going to be equal to. So we need an apportionment there, 40% apportionment. Okay, then the time of supply. That's what we want now. So for second-hand goods, we can only claim to the extent of payment. You know that. For second-hand goods, we can only claim to the extent of payment. But this is a special second-hand goods in the sense that this is fixed property. So in the case of in the case of fixed property, in the context of fixed property, so this is just term of supply for second-hand goods in general. And then we also have term of supply for fixed property. So this will be at the earlier of registration or earlier of receipt of payment, or rather earlier of payment, not just receipt. Because we looking from the perspective of the payer as well. So the earlier of registration in the name or transfer of the registration into the name of the buyer or the payment. So earlier of this. Okay. But we can only claim to the extent of the payment that was being made. Only when it has been registered, right, in the name. It has to be registered in the name of the buyer. Okay, so these are things that you need to know in terms of fixed property. So I think I will make a better presentation if I go. So this is an acquisition from a non-vendor. So when we pay that amount, there's no VAT to be paid because the guy didn't charge us VAT. However, because we are not charged VAT, we will be required to pay transfer duty instead. We are not given that transfer duty, how much it is. Okay, but we would be required to pay transfer duty if we are not paying VAT. This is much better because it's complete. Because this is acquired from a non-vendor, this is second-hand good. It was previously owned, right? So there will be a notional or deemed input tax, and it will be based on the lower of the consideration, the actual price, or the open market value. We don't have there any other, so we're gonna calculate based on the consideration, right? And we remember that there's going to be exempt supplies, so there's going to be an apportioned input tax, 40% of that. And now we come to the time of supply. So the time of supply is the earlier of the date of payment or registration. Okay, so that is correct in the name of the company, right? But we can only make a deduction only so the deduction will only be claimable on the date of registration in the name of this guy. So whatever happens, as long as there's no transfer of name, we cannot be able to make a claim. Okay. So for us to make a claim, it has to be registered first in the name of the new buyer. And again, because this is second-hand goods, we are limited to the extent that payment has been made. So when it comes to fixed property, right, we can only claim once the property has been registered in the name of the new guy. Right? But if it is second-hand, we have an additional limitation that says to the extent of the payment made. Okay. Right? So when it comes to fixed property, those are the rules that we're going to apply. We're going to apply the rules. First of all, the fixed property should have been registered in the name of the buyer. And if it was second-hand, then we can only claim to the extent of the payment that has been made. All right. So this is what you need to know in terms of fixed property. But the general rule is that the supply is the earlier of date of payment or registration. So this is where I earlier on spoke about the difference between the term of supply versus the term to claim, right? So the term of supply is the earlier of the date of registration or the date of payment. But when do you now claim? You won't be able to claim until it's registered. And because it's secondhand, you can't claim, you can only claim to the extent of the payment made towards the purchase price. You will remember this, right? Uh, when I said the value, the time of supply versus the time of claiming, right? When I said there's a difference, sometimes you recognize the time of supply is this date, but you're not allowed to claim because there are other requirements. So in this case, the requirement is, first of all, fixed property has to be registered in the name of the entity. Secondly, if it is second hand, then we can only claim to the extent of the um, of the payment that has been made, right? So I hope this makes sense to you. And then quickly, what are some of the requirements for a valid tax invoice, right? What should be there on a tax invoice for it to be valid? Now, there's also an acquisition from a vendor. Um, Right. So let's focus on the acquisition from the vendor. It says here that the second building is owned by a registered VAT vendor. The purchase price is 2.8 and it's inclusive. And then we are told that as at that time, 10% is exempt because residential accommodation is exempt. Okay. So you need to know that a residential accommodation is going to be exempt. Then gonna have 90% taxable, 10% exempt. Brilliant. So how do we do this? But we are also told that they will have to convert the residential section so that it becomes commercial immediately upon acquisition. How do we deal with such a scenario? Right. Again, this is acquired from a vendor. Excuse me. So there's no point. There's no. It's a second-hand good, yeah, definitely, but it's acquired from a vendor. So there's no need for us to worry about the notional input tax because the actual input tax was actually charged. And because VAT is payable on the transaction, there's no transfer duty that is going to be paid. Then we will have to claim input tax credits or rather may have to be claimed. That's more correct because we haven't started discussing yet on what are the requirements. Right. So because this is more like a shopping center, is it like a shopping center? Yeah. It's 90% shops, 10% residential. So we might need to look at whether this is not the sale of a going concern, which will be zero rated. So I chose this question just to remind you of a zero rated sale of a going concern. I haven't seen a question at third level which talks about the sale of going concern and the zero rating of a sale of a going concern. This is a very standard question at CTA. At CTA, the question is very standard. You get it a lot, but not much. I don't remember. Maybe there was, but we need to cover it because that's if I'm not mistaken, that has always been part of our curriculum. Okay, so the requirements, I just wanted you to remember that. So both parties should be registered for VAT. That's one of the requirements you should remember. Then the enterprise should be capable of operating separately. We're not talking of assets, but the enterprise should be able of operating. Then there must be an agreement in writing that this is a disposal as a going concern, right? then this is another agreement that the supplier, so there must be an agreement in writing again that the enterprise is an income earning activity. So they must agree that as well. The agreement should be put in writing. Um, then they must also agree that the supply is zero rated. But, okay, so these are the broad things you need to remember when for a sale to qualify as a sale, for the sale of a business to be a sale of a going concern, that the sale of a going concern is going to be zero rated. So you need to know that. All right. You need not know everything in the finest details, but you need to know those broad frameworks that you will need to refer to. Right. So if it is a zero rated sale, then there's no VAT, or rather VAT, there is VAT payable at 0%. So in other words, it's basically VAT being paid at zero. And then we cannot deduct anything because we did only pay zero there. Right. So I included that question specifically for us to cover the sale of as a going concern. And like I said to you, it's not a popular question. I've been a tutor for like a long time, I think for almost 12 years, taxation only. Because taxation, I started taxation much later. Like I told you, it's not my favorite. It's very easy, but I teach it, and every time then I have to go to the Income Tax Act and read it, the legislation, income tax legislation. And I'm not particularly proud of that. Um, so from when I became a tutor, I do not remember going concern being examined at that level. Maybe I missed that one. Now let's talk of importation. We're gonna import from other countries. So if I write this should not surprise you, right? As a taxation student, if I write this, you will know what that means. So we have an entity that bought an ingredient from Zimbabwe. So I want to apologize to you and to whoever because what I did, I should have said that at the beginning, but that's important that I must say that. So what I did, I don't even know exactly where this information I got it from. I don't know exactly where, right? Because I just took from my notes, there's so many notes. I just from this document, from that, and just put them together. So I am unable to acknowledge the sources of this. So I want to apologize for that. Next time I'll do better because it's correct principle to acknowledge that this I got it from Silk. This I got it from um, what is the other book that we used to use? Uh, Taxation of business and individuals. This I got it from tutorial later. I should have done that, but I just was just copying and pasting to compile for this discussion. So my apologies for that. Okay, but anyway, we proceed. So there is an import here from Zimbabwe. And remember that sometimes we are given the purchase price, but that's not what we really want. What we want is the customs duty value for VAT purposes. So if we are not given that customs duty value specifically, then we're going to use the purchase price as a proxy. We're going to believe that this is the um, this is the customs duty value. But in this case, we are given the customs duty value as 58,000. And then the non-refundable taxes paid at the border is 17,000. Right? So this is one transaction. So if you remember, I will deal with that. So import VAT will be paid on importation at the border. This is not input VAT. This is not input VAT. It's import VAT. It's not really input VAT. It's not output VAT, right? Because we aren't really supplying here. But um, there is a rule in the income tax that when we import, that we must pay tax to SARS. So that import VAT will be paid on importation at the border. And later on, it will qualify as an input tax because we need to deduct that. So first of all, make a payment at the border, and then later we can claim that back, right? Once we make taxable supplies, right? So first thing, we need the customs duty value, right? Plus the customs duty, which is given, plus 10% of the customs duty value. So that will be 10% of the CDV, right? You guys know this very well. And which will be 5,800. And then we get this 80,800. Then the VAT will be 15% of that. So this is what we paid at the border. And once, because we are making taxable supplies, we can also claim it back as input tax. Okay. So whether it's output tax, whether it's input tax, yes, there is input tax. This one is definitely input tax. But now the one which we pay at the border, is it even output tax? Maybe, but that's not the definition of output tax. But we have to pay that over to SARS. And the difference here, let me see. Right. So VAT is payable to SARS on the importation based on the customs duty value. This is paid to SARS directly at the customs and does not form part of the tax period returns, right? This amount can be claimed as input tax. So whenever we calculate input tax or output tax for a particular period, the amount we pay to SARS at the border is not going to be included because it just does not form part of the tax period. VAT 2014 is the VAT, what's that name again? Is it the VAT refund form? But that's what the form that you use. It used to be a form, but now I think it's entirely something you do online. Okay. So what is the case? How would this input tax have differed if it was BLNS? Well, we would have not included 10% surcharge upliftment on the customs duty value. Right. So I think this is rather straightforward, but just a reminder. Brilliant. Then we go to the next case. So this is also a very interesting case. Like I told you, with taxation, you need to know. That's why I don't like taxation because you can't reason. Because, like I said, there's this rule or rather principle, but it's going to be intermingled with many, many other clauses. So here's a case here. So soft drinks during February 2023, soft drinks were made available for sale for the staff at the function at a consideration of 10 Rand per can. And this covers both the direct and indirect costs. So this is a function, and we supply the staff, and the staff are buying at 10 Rand. And your thought is that this is entertainment, and you are indeed correct. For entertainment, input tax is denied, and you are correct, right? But now here is something interesting. It's being sold at a small price, but that price covers direct and indirect costs. So what do we do now? So that's interesting, isn't it? But we also purchased those from some guy at 7 Rand 41 per can. And then the total invoice was 7,410 for 1,000 cans. Then we sold 820 on the day and received 8,200 cash in total. Then the staff did not have to pay anything else for the function. The caterers invoiced Wesley for this function on 20th February for 31,920, and we expected to pay in March. So this is interesting. We buy some soft drink, cans of soft drink. Then we supply to our staff, but they have to pay a price. That price covers direct and indirect costs. And then there's a catering company also, which comes in to help with many other stuff in the invoice as 31,920. Right. So I want to give you a general picture before we go, where we're going. So VAT will be charged on the sales that were made and will be claimed on the purchases also that were made. Okay. So that is the general direction. But on the catering, this is still entertainment, and we won't be allowed to claim. We haven't started reasoning yet, but I'm giving you the picture so that you build the why is that the case. And then as you have the why, then we can come in and fill you up. Okay. So let's go through the reason. The reason. Right. So there's soft drinks purchased. So there's VAT that was paid. And it's going to be input tax because it relates to the making of taxable supplies. But we need to consider whether this VAT is denied due to the fact that this is entertainment. But now we have the fact that the cans are supplied at a charge which covers all the direct and indirect costs. It is not denied because it's more like a sale transaction. You see, that is the issue with taxation. There's always something else. But if this happens, so in this case, we bought it for 7,410, inclusive of VAT. So this is the input tax that we can claim. Right. So the supply of these soft drinks is a taxable supply. So we're gonna levy output tax of 1070. And then the entertainment provided by the caterer is going to be entertainment cost. But there's no although it's for making taxable supplies, it's denied because it's entertainment. Then finally, I want you to do a quick research on membership fees. When is membership fees denied? And when can input tax on membership fees be claimed? Right. So I want you to do a quick search. You can, if you haven't done that already, because that's also another interesting topic, and I'm not going to provide the information to you. Right. So we have a coffee machine. So we have a director who is a shareholder, and this guy paid 11,500 for a coffee machine that she sold to a company. Right? So she paid herself 11,500, and she says this is from a company. But the open market value was 15,000. Okay. So the shareholder is not a VAT vendor, and she only used the coffee machines for a month before selling it to her company. The coffee machine is only used to make coffee for the clients. Discuss the VAT treatment of the above transaction. All right. I chose this particular question because I know the default for most of us is a coffee machine for at the workplace, and its VAT input is denied. Well, I'm not talking about those who are the sharp ones. I'm talking about the majority of us who are general. Right. But you see here, this is being used by clients, okay, and not by the workers. So it's not entertainment. It's for business purposes. So we now kind of distinguish between taking care of clients who are our customers and taking care of our employees at work. So that's interesting. Right. So first of all, one thing we need to mention here is that this is an issue of connected parties. Okay. One is the shareholder in the transaction. So there's connected parties. And in this case, the connected party is the seller, right? But the buyer, that's the connected party is the seller. The shareholder is the seller, right? The shareholder would not ordinarily be able to claim input tax if he was the buyer. But in this case, the shareholder is the seller, right? And so the shareholder, being not a registered VAT vendor, is a natural person. We would expect natural persons to be not registered VAT vendors. Um, um, so there is no VAT paid there. However, the entity can claim a notional input tax. And the notional input tax is going to be claimed based on the lower of the purchase price or the open market value. Right? And the purchase price is 11,500. So our VAT will be 1,500. Input VAT, which can be claimed. Okay, and why is that the case? Because the coffee machine is not considered entertainment as it is used solely for clients and not by staff. Right? So that consideration makes it um, not be entertainment. So the VAT is not denied. Right. So here we have a case where let's suppose it was the opposite, where these connected persons. Okay. And we do then make a sale, right? Um, we do make a sale, right? So I want you to go to test one of the year 2024. There's a question there that deals with the sale to a connected person, right? And the connected person cannot claim input VAT. And what are the implications of that? So I want you to go to test one, 2024. There's a sale of a machine by a company to a shareholder, or is it a director? And this is a connected person. And obviously, this connected person cannot claim the full input tax or cannot claim input tax. So how does it differ in that particular regard? Right, so just for your enrichment, then I think we almost finished now. Then we have hotel accommodation. We can never be finished before we talk of hotel accommodation, isn't it? So we have Rex, who is a registered VAT vendor, who went on a business trip in George. So these are places in South Africa. If you are not in South Africa, these are places in South Africa, Cape Town and George. Um, so this was after 1 April, so the rate we use is 50%. He spent a total of 45 days. So if you see this, you know, right? In a local hotel, which charged a fee of 400 rand, excluding VAT per day, and it's a room only, right? So if it was combined, then that would be interesting. Then there's also a meal that this guy enjoyed for 6,900. So whenever these things are given separately, right? The things are given separately, then you need to know that the rules are going to apply separately as well. So how much tax will this guy pay? So obviously, because this is accommodation for 45 days, which is more than 28 days, unbroken. Remember, it has to be unbroken at 28, more than 28. Um, so this guy will pay VAT. VAT will be calculated on 60% of the total. But because this is separate, this is for accommodation only. And then we have a separate charge for meals, for which the 60% doesn't apply because it's charged separately. It's an additional service. The hotel accommodation does not include the, the meals, right? So hotel accommodation separately. But if it was combined, right, and it's not separate, then it would be 60% on the total hotel accommodation bill, right? So they try to make it very interesting, very confusing rather. So your guide, your general guide is if the amounts are given separately, then it's an indication that they want you to separate, right? Okay. But if the amounts are included as one, Uh, like you are given a hotel accommodation combined fee, right? But if you're gonna be given um, other amounts separately, then that's an indicator that those were charged separately, right? So we said that he will be able to claim the following input taxes in terms of commercial accommodation. So 45 days times 400 times 15% because this is exclusive of VAT, only 60%. Because the meals are charged separately, that 60% doesn't apply. So it's the amount being inclusive, right? The total amount being inclusive. And I think then we get 2,520. So the guy stayed for an unbroken period exceeding 28 days. Okay. Then VAT will be calculated only on 60% of that. So what else do we have? All right, so this is not considered to be entertainment because the guy is required, right, to be away from home for at least one night. So that's not going to be regarded as entertainment. According to the duties, the guy is required to be away from his home. Then moving on, uh, we quickly touch on change in use. Okay, so a change in use is when you have a certain percentage usage, then you claim input tax, and then you now have to change the taxable portion usage, right? I think that I got this um, from the from the study guide. So I'll give you a general principle. The general principle says you won't cheat stars, right? You won't cheat those guys. So they will ask you. All right, so I said you won't cheat SARS. They won't allow that. So whatever transactions you get given, because now with a change in use, there's a lot of things that can happen. That thing could eventually be exported. Like you can buy something secondhand and then export it. You can buy it from a friend. You don't pay tax. Whatever you do, then you export it. It becomes zero rated. Then that export, for example, stop ceases being a zero rated if at some point you had a benefit, right? Let's say that you claimed input tax and now you don't want to pay output tax, you export it, right? You claimed you had input tax, um, so you benefited, and now you have to sell it. You are benefiting again, but now let's say you are exporting it. And which means you won't pay any tax. So you are just gonna be the one who is benefiting, not SARS. So SARS will change the rules, even if that thing was zero rated or exempt. I'm giving you this as a general principle. It's not going to be 100% all the time, but I'm giving you this as a general rule. SARS won't allow you to cheat them. So if you're gonna create a pattern of things, so you can come across a question in the examination or in the test where there's a pattern of people benefiting from a provision of SARS, then eventually they want to sell that thing or exit the transaction without with another benefit. Uh, all right. So SARS will also adjust their rules to cater for you so that you won't cheat them. So the change in use, you need not know everything perfectly. Right. Remember that I told you, you are not working for 100%, but you need to know that if there is a benefit, you won't get away with it, right? SARS will look at um, ways you must pay back. So in this case, we have a taxpayer, right, who bought lawnmowers for 10,000, right? So he bought 10, each 10,000 inclusive of VAT. Then his intention was to sell the lawnmowers in the course of his business. Then he claimed input tax. So this is the amount that was claimed for each per lawnmower. All right. And I think this comes from the tax study guide. Then they decided to take one of the lawnmowers for private use in his garden. Then he usually sells the lawnmowers for 18,000 rand. So you see, if this guy had bought this directly for use, he wouldn't be able to claim input tax. But now he claimed the input tax through his business and now want to use it to make it a personal use, private use. Right. So SARS won't allow that. So when you buy it, right, you you got 1,300 for input tax, right? You benefited. Now you benefit again without paying tax by changing the use. So now SARS will say that you must pay output tax as you would have done if you sold that. So assume you sold it to yourself. So that's 2,348 that you must pay as output tax. All right. And so we then will be required by SARS. We can't cheat them. So we have to pay this as well. Now, let's say originally we could only claim 55% of the taxable. We were making only 55% taxable supplies. So of the input VAT, this 1,304, we could only claim therefore 55% of that. We would have to apportion at this time. But when we sell, we don't apportion output tax, like I said. So it will be the full amount of output tax. But now we can claim the previous one, which we didn't claim, right? We can claim the 45%, which we couldn't claim because at the beginning, when we acquired this, we only claimed 55%. But now, when we sell, because we going to be paying output tax to SARS at 100%, when we only claimed 55%, we are now allowed to claim the other 45%. And but it will be based on the original cost, on the previous cost. All right, then which we didn't claim. But so rather, no, it's based on the lower, isn't it? I think the rule says it's based on the lower of the market value or the original cost. We refer to that as the adjusted cost anyway. Okay. I don't want to go into a lot of details because this is the reason why you guys should get 90%. We can't try to keep on feeding information onto you and hoping you get 100. So those are some of the things you will make mistakes on because I think this is a bit advanced. But so what I would like to advise you is that you have to compensate for the remaining amount. So if you couldn't claim 45%, and now when you sell, you have to pay 100% of the output tax to SARS. You're now allowed to claim the other portion which you couldn't claim, but on the lower of the market value or 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 the adjusted cost. Right? And remember, these amounts should be comparable. If the market value includes VAT, then the adjusted cost should also include VAT because you cannot compare those two amounts and look for the lower when one has VAT and the other doesn't have VAT. Then the other quick thing that I want to share with you, I'm not going to go into details, a lot of details about change in use, is that if SARS received a benefit, you can claim it back. Just know that. If you, as a result of change in use, you are allowed to claim it back. If you received a benefit, SARS is allowed to claim it back when there's a change in use. Right. So that's the general things I will talk about change in use. And that is all. And I wouldn't advise you to work so hard because when you study as students, you must use the return on investment principle. The or even when you're writing an examination, you use the return on investment. So you study VAT is a lot of things, but you know that things that maybe make 80% of VAT are the easiest ones, right? So the 80% of your exam is going to be made up of the things that are easy. Your fuel, which you know is zero rated, your salaries of employees, which you know is exempt. It's not a supply really. And so those things that you know is going to make 80%. So right, and out of that 20 hours, you know, this 80% you get it in let's say in 10 hours, all right? Then what's the point in spending 10 more hours to just get 20%? So I don't recommend you trying to go into every corner to exhaust every knowledge. So the knowledge I gave you here is sufficient. There will be other. But for you to get that right, you need to spend 10 more hours just to get the 20%. And the first 10 hours gave you 80%. And then you spend 10 more. So, but if you probably decide to say, okay, with these 10 hours, I have 80%. So when the exam comes, I'm probably going to get 80% of the 80%. Then you get a 65%, which is fair. And you spend 10 hours doing something else. So your study technique based on the return on investment means you must make sure you cover the easiest, right, and get it right. Then the harder aspects, the harder portions, if they are harder for you, you can just quickly go through them. Just maybe 2 hours reading, and then you get 5%. Then you leave it there. So I'm going to leave it there when it comes to change in use. I'm not saying don't study it, but I'm saying I won't have to feed that into you. It will going to be your own decision. But these are the principles. Like if something was not claimed before, it has to be claimed now based on the law. But if we're selling that, we're going to be levying output tax and paying it to SARS 100%, regardless of the value of our taxable supplies. Now, so I think that is everything that I want to talk to about about today. And let me also close by touching a little bit on gross income, right? So I think I have some notes here on gross income. So I'm going to touch that. So this is just a discussion, a discussion as to whether an amount should be included in the gross income or not. Okay, so gross income is not very difficult, but I'm just giving you a platform to refine your understanding. So some guy inherited money in 2014. Then that guy bought some units, Wow, 450,000 rand each with his inheritance. Um, so there were two. Then he has since received a rental income of 10,000 per month, which he has declared to SARS. Now this guy is going to Australia and decided to sell these assets. The units were sold at 500 each to the tenants during the 2023 year of assessment. Okay, so we need or required to discuss with a reference to case law whether the 1 million that was received will be included in gross income or not. Right? So just giving you, because you haven't gone through this question before. So just giving you a brief. I think I took this question from one of the tutorial letters. Right, so this guy kept this, I would say from 2014 to 2023. So I would say that's almost 9 years, 9 years. Okay. So he kept this for 9 years. And during that time, he was receiving rent, 10,000 rand per month. Okay. And where did he get his money? It's the money that he inherited. Okay. And what did he do with the duplex units during the 9 years? He never thought of selling them or doing any business with them. But now, because he is migrating to Australia, so he has decided to sell these units. Why is he doing that? Because it's a convenient thing for him to do that, right? It's very convenient. You won't be probably not. He's not going to come back. So it's a lot of work to manage things when he's there in Australia. And the units were sold at 500,000 each to the tenants. So it's more like it's an insider trading, right? It's like a deal, a quick deal to say, hey guys, I'm going, who wants to buy this? Right. So you see that this guy just wants to get something um, from his investment. And if you look over 8 years, 9 years, you just you bought it for 450 each, and you sell for 500, just 50,000. Just that shows you he is not very much interested in making money, but just for convenience. He is forced by circumstances to do that. So this is the general dissection of the case. Now, this is how you lay out your question in your answer, in answering a question on gross income. The first step is to provide the definition, write down the definition. So your starting point, you need to write down the definition of gross income. And then you quickly or briefly refer to the relevance of each of the requirements. So what this means is we're going to mention that gross income is in cash, the total amount in cash of otherwise for the year of assessment, this and that, and this and that, and this and that. And then we show that in the case of a resident, then we saw that Nhlanhla is a resident because he's a resident of South Africa. Then the total amount, then we have the total amount here is 1 million. It was received by him for his own use, for his own benefit, on his own behalf. Then we cover all those other concepts. It is for the current year of assessment, although this guy is not in the business of manufacturing or trading, right? Right. He's not in the business of like you would have rather he's a natural person. He's not involved in any business that has to do with rentals, right? So this is not his business. Okay. So this is more like an investment that he has. And then when we look at that, we will see that the point of contention is whether this is going to be revenue in nature or capital in nature. And we refer to that as the crux of the matter, isn't it? So it's the crux of the matter is not whether this was received by him or on his own behalf for his benefit. The crux of the matter is whether it's not whether he's a resident or not, right? The crux of the matter is the discussion points, the problem. So we quickly fit in everything else, and then we now focus on the crux of the matter. So whether this is capital in nature or revenue in nature. Right? So you don't have to waste your time talking about things that are obvious. Sometimes the examiners will tell you everything or will tell you everything. Then they will say to you, just focus on this. right? So whenever we talk of a case of capital versus revenue, we are reminded rather of the tree and the fruit principle. Um, as a student of taxation, if you have done gross income, even at second level, you remember the concept of the true, is it tree, right? It's the tree, not a true. The tree and the fruit case, right? Where the tree is capital in nature, and the fruits that it produces are revenue in nature. So this is the tree and fruit principle. Okay. And so when you look at the tree versus the fruit principle, you see that the tree here is the duplexes, which produce the rental income, and the rental income is the fruit. Right. So that gives us an indication of that this for all the time that this was always being held, the duplexes were producing um, rental income. So they are more like the tree that is producing the fruit. So if we get the fruit, then that's going to be revenue. But if we sell the tree, then we have sold the capital. Okay, so that the tree is going to be capital in nature. Okay, and so now we come to the case. There's another case, um, um, apart from the tree and fruit, the principle in the stored case, right? The principle in the stored case was the stored case is a case that is used to test the intention of the taxpayer, because this particular taxpayer sold the property, and then the issue was in the courts. Right. And that the court has to determine whether this could be considered a, a, a scheme of profit making, right? Or that the taxpayer was merely realizing his capital asset to his best advantage when he sold the duplexes. So what happens is that um, a taxpayer is open to is it exigencies. It's open to the outside world. What can be influenced by the outside world. So somebody can come and make an offer for your house, and maybe that is more like double its price. You were not even thinking of selling it, but because this is beautiful, it is a good. It is to your advantage, right? Because it is to your advantage, then you will have to take that. You are merely realizing your asset to um, its best, right, to its best advantage. So I want to just give a summary. The tree and fruit is the visa case. So you need to know visa. You need to know these cases and write them down quickly. Right. And the Stott case was a case whereby somebody, a Stott, just saw an opportunity to make money um, from his assets, and then I decided um, to take the advantage. Right. So that's the Stott case. And so we need to consider whether someone is just is merely realizing his capital asset to his advantage, or is it a scheme of profit making, right? To take that further, that thing of profit making, we can use the Natal estates case, right? Where the Natal estates case went further to say we will be able to realize to determine whether it's a scheme of profit making based on the activities that the seller engaged in order to sell that particular uh, asset. So using the Natal estates case, right? The Natal estates said, did the taxpayer cross the Rubicon? Right. Okay. Because this Stott case had said that a taxpayer can realize an asset to his best advantage without changing its capital nature. So that is what Stott says. But then the Natal Estates goes further to say we can now distinguish between merely realizing a capital asset to your best advantage. Um, right. So the Natal Estates, I was saying that the Natal Estates now goes further to say, was it just a case of realizing your asset to your best advantage, or did you enter into a scheme of profit making? So the concept of entering a scheme of profit making from the Natal Estates is referred to as crossing the Rubicon. So we look at the activities that you entered into in order to dispose of that particular, but of that otherwise asset which is capital in nature, of that asset which is otherwise capital in nature. Okay, so that we would think then if you cross the Rubicon, then you've gone onto a scheme of profit making, which is reflecting of a change in intention. So the original intention was to hold, but if you cross the Rubicon, we could recognize a change in intention. So we analyze the scenario based on is it subjective or objective? Subjective. This is objective evidence. The intention, right? So we're gonna look at the intention at the beginning when it was acquired, the intention when it was whether there was a change in intent of intention or not. So that's a subjective analysis. Then we do an objective analysis in terms of to support the intention to test if the intention is indeed valid, because the one who has to demonstrate that it's capital in nature is the taxpayer, isn't it? So by first of all, the taxpayer relies on the subjective, the intention, which is subjective. And then the court is going to, or the court or the assessor is going to look at the objective factors. So these factors will say, so first of all, this is the objective. Then this is the subjective. What is your intention during the acquisition? And was there any change in intention during the period of holding that? So the objective factors which will answer to that is, what is the history of this guy's proper transactions? It was a once-off purchase, isn't it? It didn't go on into dealings with purchasing property. Just was just a once-off. Okay, so the history testifies for this guy. Then is he continuously busy with property transactions? That is not the case because just had a once-off thing and it's not something that is continuous. And how did the taxpayer, finance the purchase? So if it is own funds, this lien is leaning towards capital, right? Because then if it is borrowed funds, this is leaning towards revenue. So this is his own funds. In other words, just an inheritance, a windfall, So that would that would lean towards a capital investment. Then for how long did the taxpayer, uh, for how long did the taxpayer own this? So it's for a period of 8 or 9 years. So that's long enough to support his point that he this is a capital in nature. All right, this is capital in nature. You hold it for such a long time, the length of time which the taxpayer held the asset. And the taxpayer used extensive marketing. He didn't. He just sold to the guys who are already tenants, you know. And even if you look at the profit he made over 8 years, it's just 50,000 extra additional. That's may not be the true reflection of the market value. And what is the owner's activities prior to the selling of the asset? So he's probably involved in his own business. He has nothing to do with the rentals. And the reason for sale is that he's immigrating. It could be that he made get a good offer, but now in this case, he is um, immigrating to Australia. And although we do not know the use, but he's probably going to go with the money to Australia. So now so this was just the guidelines, and I was talking about them. So we can see that this guy bought the duplexes with the intention of keeping them, right? According to the visa case, they were going to be the tree, and the rental income received was going to be the fruit. The holding period of 9 years, and the fact that he bought them with surplus funds is objective evidence of his intention to keep it as an investment, right? He did not cross the Rubicon and go into a scheme of profit making. He just sold it quickly to the guys around. And the reason is he is immigrating. That is a realistic decision. Okay. And he didn't follow an extensive marketing strategy. And so he was merely realizing his capital assets to his best advantage. So can have remember the STOT says you can realize your assets to your best advantage. Right? Instead of just leaving them, selling them is the best thing to do to get value from them. That's the STOT case. But then the Natal Estates goes further to say, all right, as you tried to realize your assets to your best advantage, did you market extensively? Did your activities before the sale show that there's a change of intention? You crossed the Rubicon to change the intention, to make it a profit-making scheme, right? And so that's not the case again. So now you make a conclusion. And the advice there is that always conclude your argument, right? Always make a conclusion and do not contradict yourself. So even if you made a mistake, but you could get communication marks for being consistent with your argument. And then finally, this is going to be considered as capital in nature and gross income. And remember, this is your judgment as a student, but it has to follow the standards, right? It has to follow the cases, the law. That's the governing standards. Okay, and so sometimes you can get a question that is not going to ask you directly whether this amount should be included in gross income or not. You can get a question that says, discuss the tax implications. Right? And that question will require you to discuss donations tax, dividends tax, VAT, which is both input and output, capital gains tax, and your normal income tax. If a question says discuss the tax implications, but now if it is a question that says discuss tax implications, and we are on test one at the beginning, so we won't talk about donations tax, we won't talk about dividends tax, we won't talk about capital gains tax. We just talk about VAT and gross income, which we have covered, right? And so for the tax implications for gross income, then we have to consider those aspects of the gross income definition to see, for example, was it received by him on his behalf for his own benefit? Is it something that is there an amount that can be ascertained there? Is there an amount Is he a resident? Is it capital in nature? Is it revenue? And then we can conclude that it meets those requirements. Therefore, it will be included in gross income, right? And subject to income tax. So this will be part of the taxable income. Okay. And then we can also calculate the VAT implications there to say that he's not a registered VAT vendor. In that case, then there's no VAT that was levied. Right. I hope this has just given you belief in yourself, right? That you are not very far away. So if you are interested in our tutorials, you can just WhatsApp me here. Our team operates on this WhatsApp number. Right, so we do offer MS. Right, this is our mainstay. This is home, right? And FAC as well. That is home. Then for taxation, normally most students don't struggle with taxation or auditing or a bit of AIN, but if students do focus on AIN, that's quite doable, right? And a few students struggle with CAS, but we do offer support in all of them. And the reason why we offer support in all of them might surprise you. So previously, when I started tutoring, I was focusing on MSc, but then I would help students pass MSc. And then because it was still during the semester time. And 2 semesters later, somebody is still struggling with FSC. Then I think, well, maybe let me help students with both MSc and FSC. Then they pass MSc and FSC, and then they're struggling with auditing. And I'm thinking, but auditing is supposed to be easy. And so that's how we ended up teaching all the modules. For example, we were teaching MAC, FAC, taxation, auditing, AIN, and we think, and then we ask students, is CAS difficult? They say, well, our discussions were in groups and it's easy. But then you get a student who signs up for MAC, FAC, tax, AU, EAIN, 5 modules, right? And you take them through the curriculum for all the 5, and then they pass all 5, and then they fail CAS. It has happened like twice now. And so I was just explaining how we end up teaching every module. So we now teach every module because we believe we might just be the difference you need in your studies. We can't just leave you to say, taxation is easy or CAS is easy, and then you struggle, and then we could just have helped you. So we do help with every module, although we primarily focus on MSc and FSc. But the other modules are relatively easy, right? But we do offer all the modules. So if you would like assistance, you can talk to us and see if we could be of assistance. And throughout your studies, we wish you the very best in your studies, and good luck for the upcoming test. Good luck for the examination as well.